Hello and good morning, all. Thank you very much for joining us this morning for our joint webinar with BGL Corporate Solutions and our good friends at TDA Tax Depreciation. My name's Luke and I'm the sales manager at BGL, and I'll be your host for today. And I just wanted to introduce you to Hendrik, who is the sales manager at TDA, and he'll be going through some really valuable information about tax depreciation and their valuation services that they have to offer. So I'll hand it over to you, Hendrik, and you can go through what your service has to offer. And then towards the end, I'll pull up the integration that BGL has with TDA, and we can show our attendees where they can access that in the platform. So over to you, Hendrik.
Fantastic. Thank you so much for that, Luca. So again, great to meet everyone. My name's Hendrik. I'm the sales manager with TDA Tax Depreciation. Be going through today what is depreciation and valuation, how can we help businesses and property investors, and how can you best utilize this service. So, kicking straight into it, what I'll say is that most investors, as I'm sure many of you are aware, either don't claim or don't maximize their investment properties. That's what we set out to resolve and fix by utilizing these depreciation and valuation reports. Hopefully, by the end of this, you'll have an opportunity to see how we can unlock those investment properties and the full value of them. Alrighty, so what is a quantity surveyor? There are three key types of quantity surveyors. We have our pre-construction quantity surveyors, and they prepare cost plans for architects. We do bills of quantities, tender reports. We have construction quantity surveyors. They really get into the cost planning, the cash flow forecasts, and progress payments. And where we come in, where TDA specializes, is our post-construction tax depreciation reports. Now, our directors, Theo and Daniel, have worked across pre-construction, construction, and post-construction when it comes to being a quantity surveyor over the last 40, 50 years of their experience. And they went, all right, well, where can we give the best bang for our buck when it comes to the people we work with? And we looked at depreciation reports, because that's where money starts to come back to those investors. Going down, a lot of questions around what tax depreciation I know I've faced since starting the business, and we have that conversation every single day. So what is tax depreciation? Why does it matter? So the depreciation is wear and tear of a property over time, and the ATO allows you to claim that as a deduction and as obviously a write-off to your tax. Now, it's also a non-cash deduction, and what that means is that instead of paying for something up front, it's something that you already own and can claim. Big piece here is that you can also cover 40 years. You can actually, our reports cover 40 years of a property. So, moving to the line. Different properties we service. Now, there are a number of properties that may benefit. I'll talk to just a few here. But when we look at residential properties versus commercial offices, commercial warehouses, it's everything in between. So if you look at a townhouse or a unit, all the way through to your luxury properties and luxury mansions, for example, they still class under the residential properties. Going further to that, you may have places like commercial offices. Now that can be everything from your large warehouses and commercial warehouses through to what I'm sitting in right now, which is our commercial office in South Melbourne. And everything from residential through to, if I look at, for example, agricultural properties such as wineries, you can get a tax depreciation report for. So, a lot of questions come in at where it all starts. So, what can you actually claim? And apologies, pulling this up here if it's not showing on my screen, although it may be showing on yours. So, a lot of When it comes to property and tax depreciation, it all starts when it comes to how much you can actually claim back. We have a pretty nice, easy, clean rule where back in 1987, of the 16th of September 1987, you've got a flat 2.5% on all residential properties. Now you can claim everything from a building's structure and permanent fixtures, so think your wall, your floors, your roof, tiles, all the way through to your carpets and installs, which I'll get through in just a moment. Now, depending on if you're looking at Division 40 or Division 43, your property, so the actual house, for example, has a depreciation period of either 25 or even all the way up to 40 years, depending on when the property was built, so post 1987 or prior. And then you've also got all things such as your renovations through there. Luca, any questions up until this stage?
Not at this stage, Hendrik. But if any of our attendees want to put in a question into the Q&A, please feel free, and we'll be happy to get to them.
Fantastic. Alrighty. Plant and equipment. Now, obviously, we talked about how a property, you can claim the floor, you can claim the walls, you can claim the beams within it, and also the roof. A lot of people think that a tax depreciation report for an investment property is just on the house itself. Definitely not the case. You can claim, if you think about a property or a house and you think, all right, if I flip this house upside down and shake it, the things that stick around are we would know in plant and equipment. So think your mechanical and removable items. Now, this is things such as your split system air conditioner, your carpets, your hot water systems, even ovens, that would and can go into this claim. And a lot of time, we would very much recommend to put those into your depreciation reports, and we do that ahead of time. The last thing I'll go into when it comes to that particular section is scrapping. Now, scrapping is huge. I'm sure everyone listening to this will absolutely love it. But if we look at scrapping, you've got, and what that specifically is. So it's when you remove or dispose of an asset from an investment property. Now, I'll give you a few examples. And Luca, I'm sure that you've worked with people, and many of our attendees have worked with people who have gone through this type of situation. To explain scrapping in a little bit more detail. You purchase a property and your client says, yep, I'm going to knock it down. I'm going to rebuild a luxury mansion. I'm going to rebuild it in my vision. I might even subdivide the property after I knock down and build two. We have a hard and fast rule to tell absolutely everyone this without giving, obviously, financial advice. And that is that we make sure that we tell them, don't pick up the hammer yet. Now, when it comes to scrapping, the amazing thing in it is that, as I said before, we give you a 40-year depreciation report. Now, what that means is that if you have got a depreciation report prior to knocking that property down, all right, and you've also had someone, you actually rented it out, so it does class as an investment property, and speak to your accountant about that one, because I'm trying not to give the advice here, and you have had someone live in it, all right, you may be eligible to claim 100% of the remaining value of what you knock down. So think if you've got a house there, it's been around for, let's say it's $100,000 house as a purchase date. And within that property, you've gone on 10 years, you've got another 30 years of depreciation for that property. As long as it's an investment property and you get the depreciation report prior to, you can claim 100% of the remaining value of that knockdown. So I think that could be 2.5% over 30 years for that particular property. Obviously, I've seen that go up between $30,000, $40,000, and $50,000, and you can claim that as one lump sum in that particular financial year. Then you're building another, because it doesn't just stop there. Then you're building a property, and you're getting another depreciation report for that new property, and then you're claiming anywhere between $10,000 to $15,000 each year off the back of that property. So scrapping is huge. It's definitely not utilized as much as it should be for investors. And when it comes to the clients that you'll work with day in, day out, I'm sure that it's going to be relevant and part of the conversation. So please, if ever you have someone who's knocking down a building, make sure that you bring it up. Make sure you're mentioning it and saying, hey, before you even pick up that hammer, please, let's go get this report done for you to make sure you can maximize those returns. Coming on. So, big question around tax depreciation. What's the cost? Now, when it comes to our cost, it starts at only $450 plus GST for our residential properties. I do wish I could say the same for commercial. So please, if you've got commercial properties, don't be quoting $450. They do start at $450 for your commercial properties, but it's quoted on a case-by-case scenario. So if you've got a $15 million residential or $15 million commercial property, we'd want to make sure that do we need to go do a site inspection, for example? What does the actual property look like, and what can we maximize? Now, we also do those quotes on a case-by-case basis because we want to work with absolutely anyone. We want to make sure that we can maximize what they are getting back. So for any commercial properties, again, quoted on a case-by-case, but residential start at just 450 plus GST. You get a 40-year report included in that, site inspections via in-house team. Again, if necessary, some of them don't even need a site inspection. And we've got a double our fee guarantee. Now, what that means is that, let's say you've got a $450 report. If we can't get you at least double that fee in deductions in the first year, we do double our fee guarantee, which means we don't charge for it if we can't get that. I don't see that happen very often, but I have seen it in the past. So we want to make sure that we deliver as much back to people getting our reports as possible. Our fees are also 100% tax deductible. So make sure that if you're getting the depreciation reports, we do it prior to financial years so that we can get that back for you. And we can backdate up to 2 years worth of missing deductions. Last but not least, we are Australia-wide. Now, we said that we'd go and do a site inspection, and similar to our director, Theo, if you do get a inspection that needs to be done in Hamilton Island, I would personally go out there. Absolutely love the place, but we will go to absolutely anywhere in Australia to do those site inspections for our clients. Okay, Luca, any questions on our costs or what's included and up to this stage, or any from our attendees so far?
Not from me, Hendrik. It looks really attractive. No questions in the Q&A for now, but yeah, this is some good stuff.
Fantastic. Now, as our director Theo loves to say, yells it in the office, it doesn't just stop there. So I hope you're ready. I hope you're excited. We don't just do depreciation reports. We'd like to introduce you to a few and other services as well. So valuations. Now, valuations have come in as quite a huge part to our business. We get a lot of questions around them, and we do there's three main types of valuation reports. So we do stamp duty valuations, capital gains tax valuations, and retrospective and historical valuations. Now, valuation, we give current market assessment, as you see there, and we also help out with self-managed super fund. I won't talk to that too much, obviously, with BGL, but we do valuations there as well. Now, as many of you might know with the fees, I spoke to it before. Again, the valuations start at $450 plus GST, and depending on the size of the property, depending on a few other factors, they're quoted on a case-by-case basis. So please speak to us directly. More than happy to work with you on what that actually looks like for your property. Second to last, we have our franchisee opportunities. Now, currently, we have 6 franchises with us. We're looking to bring on another 4, but franchising has become a huge part of our business, with people wanting to come on that TDA journey. You don't need tax depreciation experience in the past. You don't need to be a registered quantity surveyor or a registered tax agent. We have those for you. But if you would like to know more about the franchising opportunities, please come along. We're loving the people that are coming on this journey with us, and hopefully we have some of you joining that as well. How to work with us. Now, it's really simple. If you are in the comments here or afterwards, please scan this QR code. That'll provide you all of the information, but we'll also be able to give you input in your email so we can send through some information, and we can give you the application form. Now, application form, I'll show you just here. It's how you work with us. So you go through, you have a personalized application and link for any of your investors that you might want to send on. They will enter this information which comes through to us, showcases you as a referrer. And one of the great things, if you do have an investor coming through, not only do you add value to yourself as a referrer, so you add them, creates repeat customers and people coming back to you. You'll also be able to receive a $100 commission for any successful referral you send through. So a little bit of money in the pocket, adds value to yourself as a professional, and you get to help out your clients maximize their return.